Welcome to Money Making Sense, the show that talks about all things money. Today we are revisiting buying a house. And joining me today is Cari Kimball Meabon. She is the senior loan originator with Guild Mortgage Company. And welcome to the show, Cari.
Thank you, Heather. Glad to be here.
Thanks. So, Cari,
Yes.
I am ready to buy a brand new house, and I'm going to show you a picture of it. So this is the house that I want to purchase. It's gorgeous. It's about $250,000. I am all set to get it, and I came to you and said, Cari, get me in this house. And you said, well, Heather, you actually can only afford this other house. And here's a picture of what I can afford.
I'm so sorry to inform you of that.
So we're going to go through why it is I can only afford a house based on interest rates, because actually you had told me about 7-8 months ago that I should have bought a house then because interest rates were lower than they are now. And in case anybody doesn't know, the feds have been raising interest rates slowly over the last year, and they plan to continue to raise it for another year. So can you tell us just a little bit? Let's just start with some background. What exactly how are interest rates determined based on each individual person? Like I had a bankruptcy, and so because today the Fed say, oh, interest rates are at 4.75%. So I should just be able to walk into you, and anything that I buy, no matter what, it's only going to cost me 4.75% on top of the loan that I want, right?
Well, rates have a trickle-down effect or up, depending on how you look at it. So feds will raise the rate, but by the time it gets to the consumer, it actually could be a little higher. Also, other factors will dictate the interest rate for each individual. For example, your loan-to-value or your FICO score.
So so let's say that my monthly income is $1,000. And even without my mortgage payment, if I am spending $800 of that $1,000 and I still insist on getting a loan for a mortgage, you're going to tack on more interest because I don't have a lot of money to work with.
Yeah, your debt to income ratio. So how much debt you have relative to your income. And we'll look closely at that. Depending on the program, how much debt to income is allowed. Generally speaking, we don't want to exceed roughly 43% of your income towards a new mortgage payment. And that's your new mortgage payment and any other monthly debt you have. That fluctuates a little bit depending on the program, but that's a good general guideline.
Okay, so and if, let's say I don't have a lot of debt, but I had a bankruptcy 2 years ago, how does that affect an interest rate that I might be able to get into?
It will affect that because certain programs won't allow you to move to their program if you've had a bankruptcy in the last 2 years. Some of them require waiting 7 years. Some of them are 4 years. Some of them are 2 years. And yes, each of those programs offer a different rate based on that timeline or how long it's been since you've actually been discharged from your bankruptcy.
Okay. So because I had a bankruptcy 2 years ago and I only make $1,000 a month, you've just told me that this is the house I can afford. I'm stuck with a fixer-upper.
Sounds like it, yes.
Okay. Well, I do want today's show, we are going to get into those interest rates and how does the interest rate affect your buying power? I think that's really important. So if somebody is considering buying a home, like 6-7 months ago, I was looking at buying a new home. And if I had purchased right then, the interest rate at the time, I believe, was 4.2 and a half, 4.25, I think.
Probably lower, yes. Definitely lower than now.
Yeah. And now we're about 4.5, 4.75%.
Yes. Again, depending on each individual FICO scores and loan to values, it does fluctuate within each individual as well as every day rates fluctuate. But yes, that's about right. You're probably right about. So
every day, so today it's 4.75, but tomorrow it could be 4.85%.
Yes, it could. And sometimes, depending on the market, you could actually have a midday price range. Well, they're not frequent it can happen, particularly in a volatile market. You could see a price change in the middle of a day.
Wow. So when I know before when I've purchased a house, you as my lending agent said, we need to lock you in to this interest rate. But it's a gamble because right when you lock me in, an hour later it could go down a little bit if you didn't lock me in.
It's possible, yes. So it's very important if you're serious, you're qualified, and you found a property to look at those rates. And if the rate and the payment that goes along with that rate equates to the payment that fits your budget, you may want to lock in and grab that rate, particularly now where it's pretty volatile and it looks like the trajectory is up versus down.
Yeah, because I think the feds are going to raise their interest rates right before the end of this year, 2018, again.
Yes, I've heard that could happen.
Yeah.
Yes. So we want to, if someone is thinking about buying a home and they're not sure whether they qualify or not, but they know they'd like a home, right now's the time to get off the fence. Meet with a lender they trust, get pre-qualified, find out what that house is that they can purchase that has a payment that matches their budget.
Okay, and in the next segment, we are going to go over all these interest rates and how it affects, but really quickly, tell me again why it's so important that we actually get pre-qualified. What does pre-qualified mean, and why is that so important?
Well, I think it's interesting. A lot of people will look for a home and then get financing. So they've got the cart before the horse. So they should get pre-approved, pre-qualified, so they not only know the price range, but they've had an opportunity to review their budget, find a payment that fits that budget, and then what that equates to in terms of a purchase price.
So that first home, if we go back to that first home I showed you, that was the home that I fell in love with.
I would too.
Wanted
I like
that
home.
but my price range is $250,000, and this home is actually a $400,000 home. So what you're saying is, if I went out and went, oh, this is the home I want, and now I come to you and go, I found the home, I'm going to buy it, and you go, there is no way.
Yeah, it's important. It's important for you to know before you even start shopping. You can tell your realtor, this is the price point I'm looking at. So you can narrow it down, spend time shopping for the home that you know you can buy. You've already been pre-qualified. And the other important factor when you get pre-approved, pre-qualified is when you go to negotiate for that home, the first thing the selling agent or the seller is going to ask for is, have you been pre-approved? They want to know how serious you are. And in the current environment where good homes, priced right, are going quickly, you're going to want to go in with a powerful pre-approval. You're going to want to say, I've been pre-approved. My credit has been reviewed. My assets have been reviewed, not just by a computer system online, but through someone who's qualified that says, this is truly what you qualify for based on all of your information, your credit score, your income. This is the price point that you can shop for. And then you're not wasting your time or anyone else's time. You can go out, and when you put that offer in, they're going to know you're serious and you've taken the time to be pre-approved, pre-qualified.
Great. Oh, this is the perfect time to take a break. When we come back, again, we're going to be joined with Cari Kimball Meabon. She is a senior loan originator with Guild Mortgage Company. But we're going to go into that, how do those interest rates affect my buying power? And we'll be right back with Money Making Sense. Welcome back to Money Making Sense, the show that if money affects your life in any way whatsoever, we're going to talk about it. Today, we're talking about how interest rates affect your buying power. And joining me is Cari Kimball Meabon. She is the senior loan originator with Guild Mortgage Company. Welcome back to the show, Cari.
Thanks, Heather.
So in that last segment, we went over a little bit why getting pre-approved is so important and a little bit about how interest rates can affect your buying power, but I want to go into specifics.
Okay.
So if we use sort of this house that I'm stuck with as a fixer-upper because you told me.
I know some good contractors that help you.
Thank you. Okay. Can we do a trade out with the contractors? Okay.
Yes.
So in my first example, I've pulled up a few things. If I came in to you and I said, hey, I did find a house I like. It's $250,000. What are my monthly payments going to be? What are, how do you help the buyer through that process?
If you come in, you have a $250,000 home, the first thing we're going to do is review your credit, your FICO score. Make sure that you even meet the criteria for that.
Okay, so FICO score is my credit rating.
It is.
Correct.
The Fair Isaac, yes. And it's something that most all lenders use. They'll pull from 3 bureaus, Equifax, Experian, and TransUnion are the typical ones. They'll use the middle score, and that would be your FICO score. You may have heard that term before. And oftentimes people get their credit score from, say, a credit card company for free, or some online credit bureau. You have to be careful with that because usually that is only one score. And I hear that a lot, and I don't know, they don't know which score it was.
Okay.
So lenders will use the middle of 3.
Okay, because they figure that's a sort of the average.
Average, correct.
Okay, so you pulled my FICO score, and I was 650.
Okay.
Okay,
All right.
is that good, bad,
Well, it is a
indifferent?
little bit on the lower end as
Okay.
lending goes, but it doesn't disqualify you for many loan programs.
Okay,
So we'll look at your credit. When I pull your credit, I'm going to look also at your debt. So as part of the formula, the debt to income formula, I'm going to look at your debt. I'm going to look at the minimum payment of any installment, credit card, installment being car loan, something where the
Okay.
payment doesn't change, credit card debt, any monthly debt that you have. Whatever the minimum payment is, I'm going to add that up.
okay,
And I'm going to then move to see if there were any bankruptcies, foreclosures, any other collection accounts, anything like that that may narrow the program that you fit into. So I'll review that with my client.
okay,
Once we've reviewed that and it seems to meet criteria, we'll move into income. So the income part of the debt to income formula. What is your income? That opens up many types. Obviously, you have salary, hourly, commission, self-employed. In any case, we'll come to a number of what your monthly income is.
okay.
We'll want to make sure you're full-time. And if you have additional part-time income, usually we can use that if you've been part-time for 2 years. So we'll add up your income, we'll add up your minimum monthly payments, and we come up to a debt-to-income ratio. What's missing in this is the mortgage payment.
Right.
So you're telling me you want to buy a $250,000 home.
Right.
Go ahead.
And I was just going to say, this was 7 months ago when I first came to you. And at the time, interest rates were 4.25%. That was 4.25%. But you plugged in all my numbers. And based on this first graph that we have, it looks like I qualified whatever program I was in. It was 4.5%. Even though the average interest rates for a mortgage were 4.25%, I have to actually pay 4.5% interest because of either my income or my debt to income ratio or
rising rates.
rising rates.
Yes.
Yeah. I
That's
didn't
correct.
lock in time.
That's correct.
Okay. Go ahead. Keep going with how this is going to work out.
Okay, so we'll look at current interest rates that day to run a scenario, and based on your credit score, your debt to income, we'll look at several programs, see which one not only meets the criteria for the program itself, but which ones meet your short and long-term financial goals. Which program? Is that a 30-year fixed? Is that a 15-year? We'll go through all of these. Is this a primary residence? Because that can also affect your rate. If you're buying a second home versus a rental, primary residents are the best of all the rates. Second homes sometimes can be similar as well, but once you get into rentals, then that's a different story. But let's stay with primary residence.
Okay.
Single family dwelling, because again, if you have a condo, that can affect your rate a little bit, et cetera. But in this case, we're looking, I presume, for a single family.
Single family, yep.
So we'll look at that and we'll say, okay, for $250,000, we'll estimate taxes and insurance, assuming say 20% down.
Okay.
We'll look at what that payment is. We'll add that to your current minimum debt you have, your credit cards, your installment, your student loans. And then we'll look at your income, we'll divide that out, and we'll get what you call a debt to income ratio. Some programs go as high as 50, even 55% for first-time home buyers. There's often some great programs in that direction. And we'll see just what that equates to in terms of a payment and a purchase price. Now, if the rates change, that's going to change, right?
Right.
So you want to be careful of that. And we can talk about, for example, right now in this current interest rate environment, rates are actually a little higher.
Yeah.
And how does that affect your purchasing power? How does that affect the purchase price, the dollar amount you can use or have to buy your next home? So that might be something we might want to talk about. For example, if you go from 4.5 to, let's say, 4.9, just shy of 5%.
Okay. And we have that. We actually have a graph that's 4.9%. I think that's the third one. Yeah, there we go. So in the first graph, my monthly payment would have been $1,250 a month. But then that was at 4.5%. But I waited too long. The interest rates rose, and now they're at 4.9%. I have to pay $48 more a month.
And that doesn't sound like a lot, but over the life of the loan, that's $17,000, $18,000. And also importantly, how does that affect just that half a point, or just about a half a point? Your buying power, it goes down incrementally with each quarter 0.5%. If you think about that, if we have a 1 point interest rate, 1 point hike in interest rates, that's over $100 different in this same scenario.
Right.
That's a lot.
So instead of paying $1,250 a month at 4.5%, if I wait too long, or for whatever, something crazy happens in the market and all of a sudden the interest rate is 5.5%, now I'm paying $1,350 a month.
Yes, you're over $1,350 for the same home.
The exact same home. Yeah.
Yes, that's correct.
Wow.
It's surprising. And obviously the higher the purchase price, that spread's going to grow. So again, it speaks to if you're serious about buying a home, with what potentially we're hearing rates are going to move to, you may want to get pre-approved, pre-qualified.
Okay, that's a great place to take another break. When we come back, we will talk about if we put out just a little bit more money down. So again, we're with Cari Kimball Meabon. She's a senior loan originator with Guild Mortgage Company. Welcome back to Money Making Sense, the show that talks about all things money. Today, we're talking about how interest rates affect your buying power. And joining me is Cari Kimball Meabon. She's the senior loan originator with Guild Mortgage Company. Welcome again. So, Cari, in that last segment, we had sort of stopped at if interest rates are at 4.9% on, if I buy a home at $250,000 and the interest rate is 4.9%, and I've put 20% down, meaning I came to the table with $50,000. It was my life savings. I have no more money. I cashed out my 401ks. No, I didn't do that. But I came in with $50,000 and I said, okay, so that took the house price down to actually $200,000. So the price of the home was $250,000. I put down $50,000. So I'm actually borrowing $200,000 at 4.9%. And my monthly payments were $2 shy of $1,300 a month.
Mm-hmm.
The feds are going to raise rates again at the end of the year, and I'm hearing it could be something sort of an average. If you went to a bunch of different banks, the average loan price would be 4.28% on an interest rate. So if that happens, if I don't actually lock my interest rate at 4.9 and I wait until the feds raise the rate at the end of the year, that exact same house, $50,000 down, I'm now paying $1,346. I'm paying over $1,300.
Yeah, it's quite a bit too. Isn't that shocking?
I can't afford that, Cari. And I'm starting to feel like I'm never going to actually, because even that $1,298 is like I'm going to have to eat top ramen for the rest of my lilife if I buy that. I mean,
it's no fun. I wouldn't encourage that.
How do I really afford? And I hear this from a lot of my coworkers who are younger, who, millennials, they haven't been in full-time jobs for a long time. They don't have a lot of savings. They may not be able to come up with 20% down. How are they ever supposed to get into a house?
Well, and there's so many programs for first-time home buyers. First off, a couple of things. There are 100% financing where you have literally 0% down payment.
Okay, wait, I have to stop you because isn't that how we got into the trouble we did in 2008 where there was like nobody had to come in with any down payment and so they overbought. They bought houses they couldn't really afford.
I'm not sure all of the variables that impacted that huge crisis we had. I suspect many things from people getting an adjustable rate mortgages, thinking they could sell before it started moving, the rate started moving up. I think a lot of the old stated income loans caused some issues. I think it also went beyond just the point of origination, too. I think a lot of those mortgage-backed securities were secured and sold maybe a higher quality than they were in reality. So I think there was a lot of factors that went into that.
Okay.
But there are some great programs for first-time homebuyers with zero down. They're out there. We offer them. We have to offer them. And they do have some stringent qualifications, but they're great programs in that scenario. If you don't have a down payment, but you have a good job, you've had a job for a while, and you have good credit, there are some programs for individuals.
Do you have any examples of someone like that who...
I do. In fact, right now, I won't use her last name. She's darling Jennifer. She came to me. She wanted to buy a home. She didn't think she could qualify. She didn't know the process. So we met. We went over her income, her debt. We went over her budget. I helped her with that as well. And she was surprised to know she could qualify for a home. And I think there may be a lot of people out there that are wondering, or they think they can, they don't know if they can. They may, if they're truly interested, may want to sit down with a lender, walk through the budget, their budget, walk through the process, educate themselves so you're making an educated decision. I always say that. Take the time to make an educated decision.
Okay, but can Jennifer qualify for that first home, my dream home that I want, or the fixer-upper home? Like, what type of home is she going to get into?
She's looking specifically for a condominium.
Oh, a condo.
She's single. She doesn't have children. She doesn't want the maintenance, and she travels. So for her, she would like a condominium, and her price point is a little less than we were talking. But she was surprised to know she qualified. She's thrilled. She's shopping right now because, of course, again, she doesn't want the rates to go up. Her debt to income is tight, but she sees promotions in the near future, bonuses. She's very good at saving. So she feels ready. She meets the criteria, and she's excited. And she told me a lot of people just don't know what they can qualify for. So take the time, is all I say.
Okay.
Learn what you need to feel comfortable, to know if it's now or you need to save. You need to work longer, whatever it is that makes you feel comfortable.
Well, I think the next scenario I have might sort of be where Jennifer is, in that I've worked out my budget. I know what my budget is. I cannot afford more than $1,200 a month for my mortgage payment. Not $1,200 and one penny. $1,200 even is the max, and I really don't really want to go there, but I will if I have to. But I can't do $1,201 penny.
Well, first of all, you're smart. I think it's good to know before you even meet with someone what your comfort zone is. So that's good right off the bat.
Okay. So since I did that, and so I came to you and I said I can only afford $1,200 a month. That's it. And so when you sort of reverse jerry-rigged the process. And so right now I'm saying, I want a home for $250,000 and it, my payment, I'm okay with a certain range. But now I'm saying there is no range. Like $1,200 is the max, and that I can't afford anything more than $223,000 home.
And that's exactly what's happening. So if you came in and you knew exactly the amount you wanted to spend, principal, interest, taxes, insurance, $1,200, I can reverse that out and turn that into a loan amount.
Okay.
That's perfect for you. Now, granted, we're estimating a couple of those variables, your taxes, your insurance, and the fluid interest rate, but I can give you pretty darn close the amount of home you should be shopping for.
So if I go in and I find a home, and let's say the home was listed for $221,000, and I think, okay, that's $2,000 less than my max. I'm like, great. And I put a bid in, but somebody else puts a bid in, and now I'm in a bidding war.
Which is common right now.
Exactly. So I have to know that I cannot bid for that home at $223,500. I can't do that.
Not if you want to keep your payment right at $1,200.
Okay. But what if in this scenario, this is at 20% down payment. If I came in with just $44,000, if I had a little bit more of a down payment.
Yes, of course. So that's exactly, you've hit it on the head. That's exactly what we'll do together. You'll say, I want $1,200 as my total principal, interest, taxes, and insurance. 20% down, so there's no more monthly mortgage insurance.
Right.
You'll say, if I want to go up a little bit higher, I can say, well, you can, but that needs to be cash out of hand. So that needs to be additional down payment, because you have to imagine a teeter-totter. If you want the payment at $1,200, but you want more home, then you'll need to come in with the difference in cash.
Okay. And you have that happening with somebody else, not Jennifer, but somebody else's.
Yes.
Okay.
That happens often, and I'm glad. Like I said, they know what their budget is. So I can reverse that formula. Say, what's your budget? Put it in the formula, current rates, estimated taxes and insurance, and I can tell them that loan amount. And if that isn't enough for them to buy the home you see here, the $400 or $300,
right,
they can come in with the difference. Or, of course, the option is they raise the payment that they're willing to make each month.
Okay. Thank you, Cari. We're almost out of time. Really quickly, what are some of the programs that Guild Mortgage Company has that if somebody's interested and they're in Utah and they're in the area and they say, oh, I want that Cari?
Oh, there's some great programs. Of course, the one we mentioned for first-time home buyers and some that have owned previously, 100% financing. There's some we can even help finance the closing costs, but there's a great Guild program. We refer to it as the 3-2-1, 3% down, and we give you $2,000 in Home Depot credits at closing and $1,500 towards your closing costs. So that's a rather unique program to Guild. It may be offered by other lenders as well, but I know we have it. It's hugely popular. It helps people get in a home that, once you get in a home in the scenario you described, if you don't have a lot of money, but you need, now you need a furniture, you need rugs, you need whatever appliances, you'll have the $2,000 towards that with Home Depot and $1,500 to help pay those closing costs.
Yeah, and we didn't really talk about closing costs, but when you do go in, so let's say I bought my home, it's all great, you're going to finance the loan for me, but I go to close the papers, is where they hand you the keys to your home. It's like $5,000-$6,000. I'm like, that was a shock to me. I'm like, what?
Oh, for the closing
costs.
For
the closing costs, yeah.
Yeah, and you'll want it. You can shop around. One thing is important. A large part of your closing costs are title fees. You can shop title companies. Guild Mortgage has just one flat fee. It's very small, $12.95. That's it. You will also have your appraisal, and you'll also have, those are your hard costs. So your title fees, your appraisal, any fees the lender charges, and then if you choose to, say, buy down the rate, and that's a whole other story, but
that's a whole other show.
You're going to have those costs, and then they're going to also put what they call escrows aside, and those are your taxes and insurance.
Yeah. So, okay, again, another show to explain to buyers.
Right, you can negotiate those from the seller. If you have a realtor that's experienced, and I know a few, so if you want to call me, I'll give you their names. You want a good, experienced realtor, full-time realtor that knows how to negotiate, you can get those from the seller. Oh. You can actually negotiate that as part of your transaction.
Okay, great. Well, thank you again, Cari Kimball Meabon. You are the senior loan originator with Guild Mortgage Company. And everybody's going to be running to your door and get a loan if they want to buy a home. Right.
Happy to help.
Thanks. Please watch or listen to Money Making Sense anywhere you listen to your favorite podcasts.
Thanks for being a Money Making Sense listener. Follow your common sense onto social media. Money Making Sense on Facebook, Twitter, and Instagram.